Sun Life shares are up over 6% today after the financial services company reported strong earnings and improved performance in its U.S. segment. Let's go to the CFO of Sun Life, Tim Deacon. He joins us now. Tim, thanks for your time today.
Afternoon. Pleasure to be here.
So revenue up 16.5% year over year. Let's start with the U.S., if you don't mind. Group sales were up in that segment. So were medical stop loss gains. But can you explain what that is?
Sure. Well, first off, we had a really strong finish to the year overall for Sun Life. We had $1.1 billion of underlying net income. That was up 13% year on year. Underlying earnings per share was up 17%. So really, really strong finish. And a large part of that was the U.S. In that segment, earnings were up 30% year on year. And a large part of that has been the performance on our medical stop loss business, as you noted. Sales were also up in that business. We had record sales for that business as we start to see a hardening part of that market. Now, medical stop loss is an important segment. This really is for employers who, the majority of employers in the U.S., they self-fund their medical benefits, meaning they cover the first dollar of loss. And then when claims exceed a certain threshold, they'll seek stop loss coverage. And that's the business that we provide. We've been in that business for nearly 4 decades, and we're the largest independent writer of medical stop loss. So we have a lot of large scale. And we saw in the industry, with the increase in medical costs and claims coming out of COVID, the industry saw claims experience spike in 2024. And that started to stabilize through 2025. And what you're seeing in our results is that stabilization and also recognizing the strength and the scale that we have, both in the discipline and underwriting that business, as well as in pricing it.
Is that something you can predict?
It has a difficulty in predicting because it's a stop loss protection. That means that the claims have to hit a certain threshold before this insurance coverage comes in. And that's what surprised the industry in 2024. Late in that year, there was a large amount of claims, and they were mostly late-stage cancer diagnosis. These were individuals who, through COVID, couldn't get access to preventative screening, and so therefore became sick when they were finally diagnosed, and those claims became quite expensive. The way the health system works in the U.S., that sometimes takes a while to accumulate. So that was the surprise for the industry in 2024. With our data and our underwriting, we have an ability to predict the trends that come through on that business. And we've seen that part stabilize. And also in our risk selection, when we look at the types of risks that we're underwriting, we've had a chance to look at and better predict that.
Got it. Okay, let's get to Medicaid sales also being up for you in the U.S. Would that be more people coming in or more work per person?
So our Medicaid business is, for us, really in the dental benefits side of our business. We have 3 business lines. We have employee benefits, the medical stop loss, which I just spoke about, and then the dental benefits. And for dental, we're the largest dental benefits provider in the U.S., and the Medicaid part of the business is a significant portion of that. The sales that we saw in this quarter were of state contracts. So these are states that are covering the lower income earners in the U.S., and so these are individuals who need healthcare protection, and in our case, we provide them dental benefits. We had gone into the market with a plan to reprice. This business reprices every year, and so we had a chance to reflect the increased claims that we were seeing through 2025 in those sales, and are expecting to continue to grow that business going forward.
So sorry, the metric we just had up was that it was up 48%. So that is because the cost for the services went up or more people came through?
So for the claims actually had stabilized for us. So that 43% is entirety of the overall U.S. business. So our claims on our dental side, they spiked in the second quarter and then through to the third quarter of last year. They've stabilized in Q4. So we're actually not seeing an increase in claims going forward. So instead, we're writing new business on the expectation of stabilized claims.
Okay, let's get to Canada, because I know your wealth asset management did well in this country. How much new money came in?
So we had strong flows in our wealth and asset management businesses in Canada. We're the largest writer of group retirement business. That's now $200 billion of AUM. We had positive wealth flows coming into that business. We also saw positive flows in mutual funds and in our wealth protection products as well. In Canada overall, earnings were up 14% year over year. That's a really strong result for our home market. It's a mature market, as you know. Our medium-term earnings objective for our Canadian business is 6%, so we're well ahead of that. And that was on a large part of the growth in the wealth side of the business, as well as continued positive experience on our health side of the business as well.
Let's get to Asia quickly. Individual protection is up. Can you tell me how much of your business Asia is, how much it comprises compared to North America?
Our Asia business is a really important part of our growth for our company. We're in 8 different markets across Asia. It's about 20% of our earnings overall. It was up significantly year on year, really on the back of strong growth and sales in our Hong Kong market, which is our largest market there, as well as on Indonesia. So in Hong Kong alone, sales were up 111% year on year, and in Indonesia, it was 43%.
What will be the focus for the company this coming year?
We have 3 main priorities. The first is to continue to grow our wealth and asset management part of our business. We're Canada's largest asset manager at $1.6 trillion of assets under management. That makes us a top 25 asset manager globally. Last quarter, we announced the creation of a new asset management pillar where we're bringing together all of our private asset capabilities as well as our public equity and fixed income capabilities under MFS under one umbrella. And our key focus for that is to help grow that part of the business. We expect that could be almost 50% of our earnings over time. The second priority that we have is to continue to invest in digital and AI. We see tremendous opportunities and benefits as we continue to automate our back offices and to provide better seamless client experiences. And our third priority is to continue to focus on the turnaround of our dental business in light of the Medicaid performance that we spoke about earlier.
Got it. All right, Tim, I got to leave it there. Tim Deacon is the CFO of Sun Life. Thank you for your time.